Good evening, everyone. And thank you for joining late in the evening after your hectic workday schedule. So, as you all know, that today's the session would be about mutual funds and what is the right approach for investing into mutual funds. Because we all know that mutual fund सही है, but mutual fund में invest करने का कौन सा सही तरीका है. So, I am Rajesh Jain, your trainer for the day. I am a financial planner and investment coach. So before we start the session, let me set out the ground rules. So during the session, I request everyone to keep yourself on mute. In fact, I would be muting everyone now. Uh, so during the session, the mode of communication between you and me, or the mode of interaction would be more the chat window. So I request everyone to please use the chat window liberally. Any query you have, any clarification you want, or you are not able to understand what I'm saying, any point you want me to clarify again, you can ask me to repeat through the chat window. So, am I clear? And are we all set to go? If you are ready, yes, good. Keep the chat window popping up because see in webinars, no, the only energy we get because uh, I'm just seeing my Dumbo screen, okay, and there is a wall behind it. I cannot see anything else. So the only thing that gives me energy would be your responses in the chat window. So that will let me know that okay, you guys are listening to me, and also somewhere I'm able to drive my idea. Okay, so let's get started. So let me start with introducing myself. So I'm Rajesh Jain. So personally, in terms of my qualification, I'm a commerce graduate. I did my BCom from Andhra University, Vijayawada. I also did my law from Andhra University, Vijayawada, Siddhartha Law College. I'm a fellow company secretary, and I have done my executive program in finance from IIM Kozhikode. And as I told you, I did my law from Vijayawada. I started my career as an advocate in High Court of Hyderabad in 2004. After that, I completed my CS, that is company secretaryship, and I worked in a couple of corporates like Surana Group, CK Guerrilla Group. And then I completed my program in finance from IIM Kozhikode and joined as a CFO in Horman Group. It's a German group. In 2018, I joined Veltri Group as a joint promoter and managing director. This is something which was started by a good friend. And since then, I have been associated with Ethika. Ethika is again promoted by my very close friend, Sushil Agarwal. And I've been part of this Ethika's initiative since then. Personally, I'm a semi-registered equity research analyst. I'm an AMFI registered mutual fund advisor, so don't worry, you are in a very safe hands today. I'm an IRDA registered insurance planner, and in the last couple of years, I've trained, I would say, almost like 300 plus MBA students, graduates, and corporate employees in personal financial planning, insurance, mutual funds, and stock markets. So let's start the session. It's about factors for choosing the right mutual fund. Okay, so what are the factors for choosing the right mutual fund? I'm not taking up why you should invest into mutual fund because the fact that you are here itself means that okay, you are convinced that yes, somewhere you are exploring that you should be investing into mutual funds. So we will straight away go that once you have decided to invest into mutual funds, or you may already be investing into the mutual funds, then what are the various factors that you should look into or consider while investing into it? So this is yeah. So the first factor that you need to consider while going into a mutual fund is not only mutual fund, in fact, any investment. First and foremost is why are you investing? What is the purpose for investment? So investment should not be add on. There has to be some purpose for investment. Are you investing? It should be tagged up with some of your with any one of your financial goals. In fact, in my last session, we spoke about goal-based investment planning. That how your investment should be goal-based, and each and every investment should be tagged with one or the other goal in your life. It can be like your kids' education. It can be your retirement. Like, let me hear from you. Why? are you planning to invest into mutual funds? For what purpose? What is your objective? Obviously, to get good returns and generate wealth, but what is the ultimate intention? How you want to utilize that wealth? Whether it is for children, whether it is for buying home, whether it is for buying your car, for whatever. Surendra, to repay house loan. Hi, Surendra. I think you have attended a couple of my earlier sessions as well. It was S. Surendra. His name is quite familiar to me. Yeah, thanks. Financial security. Okay. Mr. Sayed, I want you to look at whether it is financial security or financial freedom. What exactly you want to uh, achieve. So clarity of your investment objective is very important. But for what purpose? Yeah. For what purpose you are investing, starting an investment? Because the whole thing starts from there. And once you are clear with your objective, once you are very clear with your objective that whether it is my kids' education, whether it is my own financial freedom, or whether it is my own retirement planning, whether it is like Surendra said about my house loan, repayment of my house loan. I would say that early repayment, prepayment of my house loan to be more clear because you must be already be paying EMI. You want to prepay your house loan so that you are off that burden from your head. Okay. So once you're determined that, then you need to look into what actually is your risk appetite, how much risk you can take it. Okay. Because see, mutual funds are like a buffet. Okay, when you go for eating a lunch, there's a buffet, there's a platter available. Okay, just because a platter is available, can you go and consume each and every damn thing? Or just because your neighbor or your friend has filled his entire plate, can you also fill exactly the same things in your plate? Can you tell me? When you're going for a buffet, you cannot because your appetite would be different. How much you eat, what are your likes, what you can uh, consume would be completely different. The same thing even with mutual funds also. It is not just because my friend is invested into X mutual fund, I cannot replicate that exact mutual funds even for me also. Okay. I need to understand what is my risk appetite, how much risk I can take it. Because, friends, please remember, there is nothing called risk free investment. Every investment has got an inherent risk with it. Only thing is, there is a difference in the gravity of risk. Some investments can be a low risk investment, something would be moderate, something would be high risk investments. Like your fixed deposit. Your fixed deposits are perceived to be risk free, but frankly, they're not risk free. They're actually low risk. And thankfully, to remind people who feel that fixed deposits are a risk free investment, every now and then something or the other bank debacle happens, like the recently Lakshmi Vilas Bank. So they come as a reminder to you, boss, the money that you are putting in your bank is also not 100% risk free. There is an inherent risk involved in every damn thing that you invest. So you need to understand the risk appetite. So for understanding the risk appetite, you need to first exactly know what are the various types of funds that are available to you. So basically, if I say the type of funds, there are three broader category of funds. The first category is equity, second is debt, third is hybrid. Now let me come to what equity means. Okay, equity funds means, see at the end of the day, what is a mutual fund? You are paying money to a fund house. Ultimately, the fund house is investing your own money in at somewhere else. So instead of you investing at X or Y directly, it's an indirect mode of investment. So mutual funds are an indirect way of investment where you are giving your money to a mutual fund house. First, this is my money, 1 lakh rupees, 2 lakh rupees, 5 lakh rupees, whatever it is. This is my money. Please manage these funds properly, professionally, and invest it into whatever is mandated to you and try to garner higher returns. And the return should be somewhere higher than the benchmark returns. This is what the intention of investing into mutual funds is. Now, when a mutual fund, you are giving money to your mutual fund, every scheme has got an inherent objective. That is an investment domain. That where this fund manager can go and invest your money into. It is not that whatever or wherever he wishes he can invest into. It is always determined. So if it is an equity fund, he can only invest your money into shares, that is into stock market, that is into the equity capital of other companies like Reliance, Bharti Airtel, your HDFC Bank. All these companies, this fund house can go and invest into. If it is a debt fund cannot invest into stock market. What they can invest into, they can invest into debt instruments. So debt instruments would be like government treasury bonds. Every now and then, state government, central government, or PSU, they issue debt instrument. That is, they take loan from the market at an XYZ interest rate. So these mutual fund houses extend this loan to the government directly or to the PSUs, where government is a security to that. That is a sovereign debt. In addition to this, they would be even extending loans to various corporates. So based on the corporate credit rating, like AAA, AA, triple V, you should know. So once you try to understand a fund composition, you will understand what a fund is. Uh, and then hybrid. So hybrid is a combination of both equity and debt. Now, when it comes to equity, there are again different kind of funds like large cap, mid cap, small cap, multi cap, and there are sectoral funds. So large cap is a fund which can invest predominantly, that is majority of its capital can be invested into top 100 companies. It can invest only into top 100 companies, top 100 listed companies in India. Then mid cap means it can invest predominantly into 101 to 250. And anything below 250 comes under small cap. Okay. And then comes multi cap. Okay. Similarly, there is debt fund. So debt funds means where it can be invested into debt instruments. So your debt fund also comes with tenure, like a liquid fund. So if you are investing into a liquid fund, the investment tenure can be even single day. So when you can invest into single day, these funds are invested into instruments which are easily liquidated, like a government treasury bonds or commercial papers, which are for only 60 to 90 days. That's it. And similarly, if you go, so the kind of like ultra short term, when you go short and mid term, long term, when I say based on the tenure of your investment, even the fund house also tries to match the tenure of the underlying debt instrument it is capturing it. Okay. If you guys are clear about it, type yes. If you're not clear about it, please let me know so that I can actually take you with one or two example of various funds and how you can understand what is the composition of that fund. So what I told about mutual funds, is it clear to you guys? Okay, examples would be better. Is my new screen visible to you all? Okay. So this is ICICI Prudential short-term debt fund, direct plan. Okay. So if you see here, it is debt duration, which is called short duration. So there is a site called Value Research Online. So if you want to check any mutual fund, no, you can check the details on this site. So this is the kind of debt that is short duration fund. Okay. Now, where this fund predominantly, so what you can look at is what is the kind of returns this company, this fund has given, the trailing returns for the last 10 years, how this fund has performed, ranking within the category, some other funds details. Okay, these are certain risk measures. So this I have covered in my earlier session about mutual funds. Now here, if you see portfolio aggregate, that is modified duration, that is the underlying instruments where this company has, this fund has invested into, the duration is 2.76 years. That is almost 3 years. So the short-term fund is somewhere, if you want to invest for 3 years, it matches your investment tenure. And here you can see that holdings. So where the fund house has invested, and here also you can see the holdings. So where this fund house has invested, GOI securities, that is government securities, okay, government of India securities, which is called sovereign. Then it is as extended loan to LIC Housing Finance. It has given by in the form of non-convertible debentures. So this is a credit rating of this company, AAA. Similarly, if you see, there is a certificate of deposit of National Bank Agricultural. This is a PSU again. It is an A1 plus. So AAA and A1 plus are the topmost category. AAA into debentures, A1 plus for short-term debt instruments. So if you see ultimately where the money has gone, this fund 39.50% has gone into AAA rated companies debt instruments. 34.60 has gone into sovereign securities, that is government backed securities. So 34 plus 39. So almost 75% has gone to either government backed securities or AAA, that is the topmost credit quality companies in India. Okay. Then AA, that is the second best rating. This is a cash equivalent, and this is A1 plus, again the topmost in terms of short term debt. So overall, if you see, my fund is getting invested into a very low risk category because the scope of default by government is very low. The scope of default by these top rated companies is also very less. The likelihood of getting uh, default is a very less. So this is where the debt fund comes into. Okay. So similarly, if I see, I would say, let me get into a category called mid cap. So this is a mid cap fund. If I look at a mid cap fund, now if you see here, yeah, if you see the allocation, 92% is invested into equities, okay, and 7.6% into debt. So 96% is into predominantly equities. And even in equities also, where my fund has gone, if you see giant companies, that is the top 50 companies, 11.63, large companies, that is next 50, 8.53. And mid, if you see 78%. So 78% of my money has gone into mid-sized companies. That is 101 to 250. This is where my money has gone into. And same thing if I see Axis Blue Chip, Axis Blue Chip Fund. Okay. The funds I'm opting is not any recommendation and anything. Only thing is I'm taking Axis because out of all fund houses, it starts with A. So, so whatever name came to me first. So this is a large cap fund if you see. So if it's a large cap fund where the money is going into, if you see here, it has gone into giant and large. Okay. There is no investment into mid, small, or tiny companies. So based on your fund selection also, where your money is getting invested would be determined. I hope it is clear now. So once you understood your risk appetite, that okay, how much risk you can take, because as you have seen, if you have observed, the debt funds are slightly lower risk when compared to equity funds. Okay, because debt funds are more into government securities and all. Even in equity funds also, your large cap funds are less risk when compared to the other funds, and small cap has got the highest risk because the smaller the company, the larger the size, the larger the probability would be that the company may collapse or the company may not do good in future and then its share price may fall. Isn't it? Because like when compared to HDFC Bank versus the small Lakshmi Vilas Bank, you can see HDFC Bank is very stable. Lakshmi Vilas Bank not so stable. Okay. So this is how you need to look into. So then once you have looked into your investment objective and risk appetite, what is the third thing that you need to be very clear about is investment tenure. Like uh, Surendra said, he want to go for a repayment of his house loan. So repayment of house loan would have been for 5 years, 10 years, 15 years. So what would be his investment tenure? So Surendra, if I'm in place of Surendra, my investment tenure would be that I want to accumulate my money for a year, and once in every year, I can go for a prepayment. Okay. So say for example, I'm earning about a lakh rupee and my SIP is 25,000. Out of 20, so 25,000 is already my existing SIP. Out of balance 75,000, I'm still able to save some 25 to 30,000. So I can invest this 30,000 into some mutual funds through an SIP, and then at the end of the year, I would be accumulating some 2.5, 3.5 lakhs, and then I can decide whether to pay a lump sum repayment, one-time repayment every year of 2.5 to 3 lakhs as per my convenience. Okay. So here what happens, my investment tenure becomes only 1 year. So if it is 1 year, can I take very high risk? No, I cannot take. I will have to go for something very safe. Though my return will be slightly lower, but something very safe return. So safe would be debt fund. So I would choose to go for a debt fund rather than go for an equity fund. Okay. At the same time, say I'm investing for my kids' future. So my daughter Naina is 13 years old and my younger daughter Achal is 11 years old. So if I'm investing for my kids' future, okay, I have got some 10 plus years down the line now for their future to save for their future. So if it is 10 plus years, I know that yes, for 10 years I can take a very slightly higher risk than what I can take for only for a year. So where I can invest a majority of my money into equity funds. And even in equity, I can actually take slightly higher risk and go into some small cap or big cap funds. Okay. Same thing if I'm going for buying a house, that I want to buy a house in next 2 or 3 years. So I want to accumulate money for my down payment. So it is only a 3 years tenure. So if it is a 3 years tenure, now you tell me where would you invest? Whether you would invest into a debt fund or you invest into an equity fund. Please suggest me. I'm looking for your suggestion. My investment objective is that I want to invest my money for buying a house so that I can accumulate money for my down payment. Okay. My risk appetite, I'm moderate. I'm neither very aggressive, neither very conservative. And my investment tenure is maximum 3 years. That within 3 years, I want to buy a house. Now, where should I invest? Should I invest into a debt fund or an equity fund? Sham says hybrid fund. Debosmita says equity. Vaibhav says hybrid. Surendra says debt. Now, nothing right or wrong. It is all dependent on your risk. But this is what is the suggested thing. So based on your tenure of investment, that is tenure, and based and this is a risk category of that particular fund, what is the returns that you can expect? So this is a suggested thing from our end. So if you are investing for something with a 1 to 3 years, so I would suggest you to go for a short-term debt fund. If you saw, first we saw ICICI short-term debt fund. So where we saw that the average tenure of the debt instruments which this fund is holding is 2.76 years, which is almost 3 years. My investment tenure is also 3 years, so it matches with that. So short-term debt fund I would invest where I can expect a return of something around 7 to 8%, which is higher than if I invest into FDs, isn't it? At the same time, the probability of me losing my principal is almost zero. I would not say zero, but almost negligent, because there historically there had been no instance where a short-term debt fund there had been a negative return. Okay, so based on this, but same thing if I go for an equity fund, and tomorrow if 2 years down the line stock market collapses, and exactly at that point of time, if I go for a redemption, what will happen? I will lose my principal. So that is the reason. It's not that okay, equity is like a volatility. In next 2 years, 3 years, you may get a higher return, you may get a lower return, but there is a high risk involved. If you are prepared to take the high risk, fine. If you are not prepared to take very high risk, you are not prepared to lose your principal, then you can take a conservative approach and go for a debt fund. Short-term debt, even FDs in small banks is almost same percentage as short-term debt. Yeah, Venkatesh, in small banks, FDs may give you somewhere around 7 to 8%, but the default rate of the small banks is now getting very high. First thing is assurity. Where are you? So where are you investing your money into? Are you investing into a very safe thing? So what is the kind of risk that you are taking up? First thing. Second thing is, as Surendra rightly pointed, taxability. So the amount that income that you are getting into a fixed deposit is completely taxable. But if you are investing into a short-term debt fund and if you are redeeming it after 3 years, there will be only a capital gain tax of 10%, and that too with indexation benefit. So it depends on your tax net. So if you are into a 30% tax bracket, even 100 rupees, 1,000 rupees, or 10,000 rupees interest which you get on your FDs would be taxable at 30%. So I would again cover this taxability section later. So once you have chosen your investment tenure and everything based on your objective, next, what is the $1,000,000 question is whether I should go for SIP or lump sum. Yeah, Demosmith, I will come to taxability of mutual fund. That is added into this presentation today. I would be taking up later. Okay. So SIP versus lump sum. So normally many people ask me, Rajesh, should I go for an SIP or should I go for lump sum that whenever market falls, I will invest. Okay. So it is theoretically, it looks very good that, okay, time the market, that whenever market falls, you go and invest. Whenever market is very high, you redeem your money. Okay. Theoretically, it is very, but practically, I've never seen anyone timing the market because no one knows when market is going to go high. No one can predict when market can fall. Like even today, currently, if you see, things are not really great around you. Okay, because of now there is a sword of second wave of COVID hanging around. But still, your market has been booming, booming, booming for the last 5, 6 months, as if like everything is really great. Okay, so suddenly someday the second wave comes out and there is a lockdown declared, you may see again a collapse into the stock market. So you can never know when that collapse is going to happen. So timing the market is not very easy. So we always suggest to go for a combination of SIP plus lump sum. That is, take a disciplined approach where you regularly invest into mutual funds through SIP. At the same time, whenever you get a big amount, park it into a debt fund, and whenever you see a market collapse, add it up to your equity fund. This is what we normally suggest, which is practically implementable. So any suggestion should be practically implementable. It should not be theoretically looking good. And if you see how the returns are given, so if you have just taken Axis various equity funds from Axis small cap, mid cap, blue chip, long term equity, and focus 25. If you see what is the kind of return SIP has given versus absolute, that is, if I've invested 1 lakh 3 years back and today that 1 lakh would have grown by 10% every year on year. At the same time, if I'm investing 10,000 every month or 1,000, 2,000, 5,000, whatever may be amount, if I'm investing, my return would be 18%. So systematic investment plan have most of the time given a better return than absolute return. And the only reason is because it is investing throughout the volatility cycle. That is, even when the market is falling, it is investing. Even when the market is rising, it is investing. So there is an averaging out, and whenever market goes up, your overall return becomes higher. So I repeat, what I suggest is go with an SIP approach with that whenever you get a lump sum, that when you get a bonus, when you get a higher increment, what you do is that 50,000, 1 lakh, invest first into a debt fund, park it into a debt fund, and whenever you see there's a market correction happening, invest it lump sum. Or if you don't want to take the debt, whenever you go into invest into a lump sum and you ask your advisor, he will advise you that, okay, which fund you should go for a debt fund, and then you can do a systematic transfer to your equity funds in the next 6 months or 10 months. And then finally, once you have chosen, then what should be the composition? That is how you can make a mix of your portfolio. How can you actually do a composition of a portfolio? So what we normally recommend. So this is a recommended allocation. Okay, no hard and fast rule. This is a recommended allocation which we generally take up for our clients. Okay. And yes, we tweak it here and there based on the customized requirement of a proper client. That is, if you have a very conservative approach, then I would recommend you invest 30% of your money. That is, if you are investing 10,000 as an SIP, 3,000 should go into a large cap fund, 3,000 should go into a multi-cap fund, and 4,000 should go into a debt fund. So if you have a very conservative approach, so that your portfolio at any point of time, the probability of your portfolio going negative would be very low. Second thing is whether market goes up or down, on an average, you will get a return of about 8 to 9%. This is what the conservative approach is. No, if you are prepared to take a slightly higher risk, that is a moderate risk, then what you can do, you can spread your allocation of that 40% into debt, you can reduce it to 20%, and the balance 20% can go into 10% mid cap and 10% small cap. There's an error here, it is not 20%, it is 10% and 10%. 10% into mid cap and 10% small cap. And if someone is very aggressive, like I have a 10 years horizon, that minimum 10 years I'm going to invest every year, Rajesh, and I'm prepared to take risk no matter, because temporarily whether my fund goes down also I'm fine, because I have a very long-term horizon. So I'm looking for a very higher return. In that case, for an aggressive portfolio, what you can do is you can put 20% into a large and mid cap, 40% into multi-cap. Multi-cap means the fund manager can invest into any category. Now, I just would like to make a small correction. Now, this multi-cap, there is a new category that is added, that is flexi-cap. Because multi-cap has come with restrictions, so most of the multi-cap funds have been again recrystallised, that is renamed as flexi-cap. Flexi-cap means the fund manager has a flexibility of investing into any kind of funds, that is large, mid, small, any kind of fund. Okay, so flexi-cap. So I would actually correct it as a flexi-cap 20%, and then 40%, then mid and small cap 20%. So this is a more aggressive portfolio where you can go with a lot of aggressive exposure. So you can take a snapshot of this if you want. So basically, to sum up, where you should invest is if you are a risk taker for your short-term goal, you should invest into short-term debt funds, and for long-term, you should go more into mid-cap, small-cap, multi-cap, and credit risk funds. Debt funds also, there is a category called credit risk where you can take a higher risk. And if you are a risk avoider, you want to avoid risk, for your short-term goal, you should put it in your money into liquid fund, or you can keep it parked safely into your savings funds or your sweeping fixed deposit also. For long-term goal, you can put it into large cap funds, balance funds, long-term debt funds, gold ETF, and Nifty index funds. So now let me take on few frequently asked questions. Okay, so which I get in most of my sessions. The first thing is, yes, Rajesh, which fund is better, direct versus regular mutual funds? Okay, about 2 years back, no one used to speak about direct funds, but in last 2 years, with the advent of lot of new apps, that is Grow and all those stuff, ET funds and all those stuff, there is a huge craze in the people of investing into direct funds. Okay. Now, which one is better? The first thing is, let me tell you what is the difference between a direct fund and regular fund. Direct fund is where you have selected a fund, so you go, you choose which fund I should invest, you select a fund, and then you review and monitor this fund on regular basis on your own, and you invest into that fund. That is a direct fund. There is another fund that is like, you come to an advisor like me and ask me, Rajesh, I want to invest 10,000. So I would recommend you that, okay, this is all of the funds which you can invest into, and we regularly review your portfolio and say, okay, this fund is not performing well, let us change to this fund, and do all those changes. So then you would be investing into a regular fund. So that is the same fund. Like if I say Axis Blue Chip, so Axis Blue Chip fund, if you're directly investing, it would be Axis Blue Chip Direct. If you're investing through me, it would be Axis Blue Chip Regular. So what is the difference? Fund composition, there is no difference. The major difference is in expense ratio. So expense ratio, what happens is there's an expense ratio difference of about 0.6% to 0.8%. Yes, so 0.6% to 0.8% is a difference. And why the difference is? Because that difference comes as a commission that is paid out to us as a mutual fund advisors. So which one is better? Frankly speaking, if you can select a proper mutual fund, you know, okay, for your investment horizon, investment tenure, this is a category of mutual fund I should invest into. Okay. And I know how to review my mutual funds and make the required changes very frequently. I'm investing, I'm able to invest my time, and I know more about mutual funds, then a direct fund is anytime better. But if you are not sure about mutual funds and you're only dependent on the ratings that are given by the app or suggestions of your friends, then I would suggest you to go for a regular, go approach a good mutual fund advisor and select funds through him. Because at the end of the day, trying to save this 0.6 or 0.8% may be very costlier in comparison to investing into a wrong fund and losing your money. Okay. So you should not end like penny wise, pound foolish. So it all depends on your own ability. If you are able to manage your own funds, go for a direct fund. If you are not, you need some support, then please take support of a professional. Okay. Don't be a uh, penny saver and risk your pounds. Second, how many mutual funds schemes should I invest? More the better. Many people want to go for a like spread. They want a platter. They will invest into 8 funds, 10 funds, 12 funds. I've seen certain when we do uh, the mutual fund portfolio review of few of the clients who come new to us and they want us to review the portfolio and recommend that okay, which should continue, which should I hold, and which should redeem. Most of the times I see that there is a platter of funds. That is more than 10 funds at a time. Okay. Because more than 10 funds at a time, you're only duplicating your funds at the end of the day because there's the same investment gambit. So the diversification should be in the category of the fund you invest rather than multiple funds. Because managing it would be very risky. Second thing is the overall portfolio. There is no historically any proven data that if I invest in a one good fund, the return that I would get rather than investing in 2 to 3 funds, I would get a better return. There is no proof for it. Okay. We normally recommend our clients any fund of a number between 4 to 6. Minimum 4 funds we recommend, maximum 6 funds. Of course, if someone is investing only 2,000 or 4,000 as an SIP, we don't go more for more than 2 to 3 funds. And they have get received a very good decent returns. So don't go for like more the better. Okay. Be very clear. Third thing, people go like most of your ratings come because of historical returns. So don't go just with the historical return because there is enough data that has proven that one fund manager has given very good returns for 1 to 2 years, and after third year, it has completely dropped the returns. Like if you see returns of HDFC top 100, HDFC top 200, at one time it was most sought after. The last 2 years it has given pathetic return. When we recommend funds, what we see is how the fund performance had been or how the fund manager performance had been over the cycles. That when there is an ups and downs, overall how the fund has consistently performed. So we look at more of consistently performed, and we know that it is a very good fund house and it is a better managed fund manager. A fund manager has been there with the fund house for a very long time. Then we recommend that fund. We don't recommend our clients any of the new funds, any NFOs. We have never recommended any of our clients to invest into NFOs. We always look for an established fund with at least a track record of 3 to 5 years minimum. Then comes a question that what is an ELSS fund? It is called equity linked savings scheme funds. So your ELSS funds are a tax saving funds for your ATC purpose. Okay, most of you must be saving your money for the ATC purpose. That is 1.5 lakhs your saving bracket. So your ELSS funds are the tax saving funds for that ATC purpose where your 1,50,000 limit can be looked for. Now, ELSS funds come with a lock-in of 3 years. 3 years from every redemption. That is, if you are doing an SIP, so I want to invest 1,20,000 into a fund, so I've done an SIP of 10,000. Every 10,000 that is invested would have a lock-in period of 3 years. So say I'm investing for the last 3 years, So the first installment would be available for redemption, but the next again I need to wait. It is 3 years every tranche. So January it is January 2007 if it is invested, it will be in the lock-in until January 2020. February 2017 the money that is invested it would be under lock-in till February 2020. So 3 years is a lock-in period. So it is basically for the ATC tax benefit. Most of our clients we suggest them to go for like a combination of a term insurance plus ELSS funds for your ATC limits. We don't recommend any other insurance policies or LIC policies or anything. We recommend them a combination of it term insurance plus your ELSS funds. Narsima, if you are already having HDFC top 100 mutual fund, okay, so HDFC top 100 has not been performing really great in the last few months. What you can do is if you are continuing your, if it is an SIP, then stop your SIP and start an SIP into an efficient fund. And if you have been invested into this fund for a very long time, and this fund has given, if you are invested like 5 years, 6 years, 10 years, in the last 5 to 10 years, this fund has given a very decent returns. So you can actually redeem this and instead of redeeming, or you can switch it to any other fund category which you want to. You can, in fact, from top 100, you can go to a flexicap fund. Okay. So I cannot recommend you straight away unless I look at the entire portfolio. So what is the combination of the portfolio? So where you are very heavy. So if you are heavy on large cap, so we can recommend you to diversify to slightly to mid and small cap. If you are heavy on mid and small cap, then we may recommend you to continue that amount into the large cap only. So depending on your entire portfolio, we can recommend based on. Then the question which Debosmita asked is taxability on mutual funds. So what is the taxability on mutual funds? Now, taxability on mutual funds, on equity funds and debt funds, it is different. So if it is an equity funds, so uh, mutual funds, it is called capital gain tax. Okay. So the capital gain tax on equity funds, if you are selling any of your units, that is any of your money that you are invested, you are selling it after a year from the date of investment, then the gains up to 1 lakh, that is up to first 1 lakh rupee gain, it is exempt from tax. Over and above this 1 lakh, is taxed at 10%, straight away 10%. You may be under 20%, 30% tax bracket, but the taxability would be only 10%. That is called long-term capital gain tax. But if you are investing into an equity fund and selling the fund in just 1 year, then any gain, the probability of gain may be low, but any gain would be taxable at a straight uh, rate of 15%. And this taxability is only when you sell a mutual fund unit. If you have been holding for 2 years, 3 years, for every appreciation, you need not pay tax on any. Only when you sell the units in that particular year only you pay the tax. The same thing with debt funds. Now, debt funds, if any debt fund is sold after 3 years, then it is taxed at a rate of 20% with an indexation benefit, inflation. So effectively, due to indexation, effectively here also the tax liability would be somewhere around 10 to 12%. It will not be more than 10-12%. And if you are selling it before 3 years, then whatever is your applicable, that is higher tax level. If you are into 20% tax slab, it would be 20%. If you are into 30%, it is 30%. But the same thing, if you are investing into fixed deposits, whether it is 3 years, 4 years, 5 years, or 10 years, it is always taxed at a slab rate of whatever is higher applicable to you. So if you are someone who has into 20 and 30% category, I would suggest you to park your funds into a short-term or long-term debt funds rather than fixed deposit because they are much more tax efficient. So how can we support is, as I told you, I'm a financial planner and an investment coach. So if anyone of you want a free financial planning thing, I can actually do a complete financial planning for you, where we do a holistic financial plan. We try to review what is your annual saving potential. We take into consideration what are your key financial goals, and then to try to curate an investment solution for you. So, as I told, we do a lot of training programs. Personally, I do a lot of training programs. So these are the glimpses of few training programs about various topics. This is a financial planning session which are being led in couple of corporate employees. Because earlier we used to do physical session. Now webinars are much more popular. This is our stock market session, Learn to Work, which was done in, I think, Hotel Abode. Yeah, was done in Hotel Abode. This is a session which is led in NMSME, that is Small and Medium Enterprises Training Institute. This is a this is a session on fundamental analysis that was done for MBA students of Sentence, Malapur, Sentence College for Women. This is for corporate employees of Hometown. This is corporate employees of some corporate employees of an architect company. This is in an MBA college. So we request you all to please, if you want to stay in touch with me, if you want me to respond to any of your queries or anything, there is a link that has been posted into the chat window. The link will take you to a WhatsApp group, which is a financial hi-fi club. So there you would be getting an indication of the future session, because every month I take one or the other session based on the request that, like last session, many of the people said that Rajesh, we want a session on mutual fund. So we took on a mutual fund. So earlier there was a session on goal-based investment. Prior to that, there was a session on retirement planning. So we do take a lot of sessions. Every month we take one or the other session. So please, I request you all to join this Hi-Fi Club, and also share about this Hi-Fi Club with your friends and colleagues in your company, so that they can join this and they can, if you really like this session, please join this club. This is my WhatsApp number and my email ID in case you want to contact me directly. Yeah. I would just actually allow you all to unmute yourself. So if you want to ask any query, you can actually unmute yourself and speak up. If you want to share any feedback about like how you felt about the session or anything that you want to share up, you can now unmute yourself and speak up 1% at a time. Yes, Vaibhav, once the funds, mid equity, etc., are decided, how do we decide on the actual mutual fund? Actual fund like Axis, HDFC, or Sundaram. Vaibhav, that is what exactly I told you, that what kind of things that we look at. So what we look at is what is the composition of the funds, where the fund has been investment predominantly into, right, how the consistent the returns has been, and then we look at. And my personal criteria of evaluating a fund is I first shortlist fund houses. I don't go with selected funds. I always shortlist fund houses. I go with the fund house, see how most of the funds of that fund house have been performing. So if a fund house has like 10 equity schemes, if out of 10, like 7 to 8 funds have been really doing in the top 3, top 5 categories, that means somewhere the fund house as such has got a very good systems in place. So irrespective of who the fund manager is, overall the fund house has been performing really well. So we shortlist based on that and then look into. Like if you see about Axis, HDFC, and Sundaram, if you just go on value research and try to see the top funds of Axis, how they have been performing, of HDFC, how they have been performing, and Sundaram, how they have been performing, you will see Axis funds have been much more consistent and have been given very good returns compared to any of the funds of HDFC or Sundaram. Okay. So that is how we look into. I took you on value research online. Value research online is there. The site which I opened up. Value research online is a very good site for getting all the information about the mutual funds. So any other queries, anything or any feedback you want to share about today's session? I think my colleague Ashriya shared even the link also for your reviews, the Facebook page link. You can share your review on this Facebook page link.
So we have a question from Nitin that in mutual funds, what is the best amount to save monthly?
Yeah. Nitin, best amount to save monthly is 20% of your annual monthly income. So if you are earning say about 1 lakh rupees, please invest about 20,000 as an SIP. And if you are earning say 20,000 rupees, please say somewhere around 3 to 4,000. So minimum 10%, recommended is 20%, and your target should be that you should go up to 30%. Okay. So it is not about amount, it should always be looked at as a percentage of your income. So depending on your income, please try to see that you save at least 20% of your monthly income. The best way would be invest into mutual funds through an SIP route. Am I clear, Nitin? I hope I have responded to your query properly. So it is not an amount.
Yeah. Rajesh, Narsimha here.
Yeah, Narsimha.
Yeah. Thanks for the enablement, sir. This information is very good for beginners, actually. So.
Yes, sir.
Yeah. I mean, I feel very happy. Like you have shared some of the punch points of mutual funds. Like because if somebody goes to website, right, it is like a tare jamin par. It is confusing.
Yeah.
Yeah, and moreover, another challenge is which advisor to trust. That itself is a big $1 million question, because if you want to say, it's like trusting a advisor, right? So because almost we are keeping our life in the hands of an advisor. Am I right?
So, Mr. Narsimha, to answer to your query, which advisor to trust? Okay.
Yeah.
By the way, what is your work profile? What are you? What is your work profile? What is your work profile?
Nature
what do you
do? IT industry only, sir.
No, IT industry only, but which, like, you are a manager, senior manager, like how it is?
Yeah. I am like a manager, basically. Yeah.
So you are like a manager. So you conduct a lot of interviews, you hire a lot of freshers and all.
Correct.
So you don't know anything about them except for the resume, what they have written. And nowadays, most of the resumes are copy pasted, they are actually written through by using some professional services, isn't it?
Correct, sir.
Okay.
You're right.
Okay. Now, how do you evaluate them? By asking few questions, isn't it? On different domains to evaluate that whether that guy is bluffing or he actually knows he has a stuff, isn't it?
Correct, sir. You are right. Yeah.
Same thing, I would recommend you when you are choosing your financial advisor, go for a financial advisor, ask him 10 to 15 questions. Okay. If that guys respond to each and every question of your patiently without saying, boss, why are you getting into all this stuff? Leave it. I'm there. No, please trust me. Main hu na. Okay. So main hu na seats only for Shah Rukh Khan, not for the financial advisor.
Correct, sir. Yeah. Okay. That is true.
So they say, no, nenu unnanu parvaledu. Okay. So Mehuna will not suit for him. Ask him 10 to 15 questions. Second thing is, go for an advisor who has a knowledge about every financial asset.
Okay.
If you go for a person who is dealing into insurance, for him, if you ask him any requirement, he will give you some other insurance product only.
Correct, sir. Yes.
If you go to somebody, a mutual fund advisor, for every damn thing, he will come with your mutual fund product only.
Correct.
If you go to a stockbroker for everything, boss, you give your money to me, open a demat account. See, in the last 1 year, we have given 15% return.
Correct.
Okay. So go for someone who will act as a financial planner and give you a holistic advice. So if you know that, okay, he's understanding my requirement, he's trying to invest his energy in understanding my requirement and then trying to give an advice which will best suited to me, keeping all those factors, that is your investment objective, your risk appetite, your investment tenure, everything in mind, then you can shortlist your financial advisor. At the same, but still you may end up goofing yourself because it's like a marriage. Okay. But still at the end of the day,
correct. What matters is your fate and luck, right?
Not only fate and luck, you need to go explore yourself, evaluate properly. Don't blindly trust anyone.
Correct. Yes.
Only trust yourself. Don't trust anyone else.
Correct, okay, sir. That lesson we will learn after burning some fingers. Everybody in life.
Experience is the best master. No worry.
Correct, sir. Correct. You are right. Yeah.
And don't worry, you have got people like us who have an experience, so you can learn from our experience rather than experiencing yourself.
Correct, okay, sir.
Yeah.
Yes. Thank you, sir.
Yeah. Thank you. Nitin, I like to invest in 5 mutual funds. It is better than 20%. My plan is almost for retirement and my child study plan. Really, this 20% would be helpful, or early by what percent? Should be I rise so that it would help in future. How much should I increase percentage? Okay, Nitin, I can actually see if you can actually reach out to me on a WhatsApp. This thing was it's a slightly lengthy because there are about 3 to 4 questions which I will have to ask you because I need to understand information. See, I cannot give you a motherhood solution unless I really understand each and everything in detail. I cannot respond to you. Okay, Nitin? So, as I told you, see 9704030202 is my WhatsApp number. In fact, if you join the Hi-Fi Club, I'm there on the WhatsApp group also. They can reach out to me directly. You can even post the query into Hi-Fi Club. In fact, I recommend most of the people to post the query into Hi-Fi Club only, so that others also into the group can benefit from that query. But Nitin, please ping me on WhatsApp. I will surely respond to your query. Any other questions, or can we wrap up the session? And any suggestions for future session? That is, what you want me to take up in my next session. If you have any suggestions, please post it here into the chat window, or you can join the Hi-Fi Club and post it into the Hi-Fi Club. Surely, your request would be my command for me. So I would surely take up whatever majority request. I will surely take up